don't trust stock buybacks. You hear about them all the time. I'm telling you not to trust them. I'm new to this. I used to believe that large buybacks were companies would purchase their own shares in the open market in order to take some stock out of the equation. Something reduces the number of shares outstanding. I used to think, hey, look, it boosts the earnings per share. I almost always thought they were worthwhile. I thought they were a nice trampoline. Bad buybacks were the exception, not the rule. Buybacks, like dividends, are ways for companies to return capital to you, to reward shareholders with cash. But we now know that dividends turned out to be much better than buybacks when a market gets really awful. Buybacks have become increasingly popular in recent years. From the fourth quarter of 2004 through 2008, do you know that all the companies in the S&P 500 spent a total of $1.73 trillion on stock buybacks? That's almost twice the $907 billion they spent on dividends. Unfortunately, these buybacks haven't given us the value we thought they would, and in many cases, they turned out to be a gigantic waste of corporate money.
The House of Pain.
So when you see a company with a large buyback and a puny dividend, I am telling you I want you to be skeptical. I want you to be suspicious, to be wary, rather than be bullish. The track record looks better thanks to the huge rally of 2009. But in the wake of the 2008 crash, it's still not hard to find companies that squandered their money buying back shares of a lot of their stock at much higher prices, leaving shareholders with nothing to show for the billions spent on buying back stock. Some companies have been a whole lot worse than others. Now, let's take the HMOs, for instance. You know, those health maintenance organizations, Aetna, WellPoint, United Health. They all stand out as some of the worst buyback offenders. These are the kinds of large, mature businesses throw off a lot of cash that you would expect to pay large dividends. But these companies kept their dividends small in order to finance massive buybacks on gigantic scales in 2006, 2007, 2008, even as, in some cases, insiders were actually selling their stock at the same time as the company was buying. And I got to tell you something. That is one of the ultimate red flags. No. It's the red flag. If you ever believe buybacks were always beneficial to shareholders, these three HMOs surely prove that argument wrong. The buybacks did absolutely nothing for the stocks and were far less helpful than paying meaningful dividends that would have been, do you know that all three companies had the money to be able to give you a yield of over 4% if they converted that buyback money into dividends? That's a level where the yield becomes accidentally high, making the stocks far more attractive than cash, far more attractive than a lot of other stocks in the market. Instead of paying big dividends, though, Aetna, WellPoint, and UNH blew billions of dollars on buybacks that amounted to nothing. So why do executives seem to like buybacks so much? Let me give you a couple of reasons. Some of it's kind of what I regard as almost sleight of hand. With the HMOs, they were some of the worst cases of companies buying back shares in order to generate cheap earnings per share growth. Since a company's earnings per share is just its net income divided by the total number of shares, a buyback can be a great way to create the perception of growth. You're taking out shares, right? So you divide it, and it's obviously you get a bigger earnings per share number. What about the notion that a buyback can help cushion a stock's fall in a bear market by ensuring that there's always a buyer ready to step in and purchase stock? For the longest time I believed that, but I now know the evidence says otherwise in a really bad bear market. Short sellers or just ordinary sellers in a panic, of which we saw panics develop pretty easily.
That was easy.
Can almost always overpower a company trying to prop up its own stock, especially as there are restrictions on how much companies can buy in on a given day. Again, a dividend does a much better job of creating yield support, trampoline. No group was more aggressive when it came to buybacks than the banks leading up to the crash of 2008. But the buybacks didn't do an ounce of good at holding those stocks up when they faced that rapid-fire onslaught of short selling that hammered down every bank in sight. Sell. As soon as the shorts were armed with newfound power to bang down stocks over and over again, well, that was the end of the buyback game. Power, by the way, that was granted to them, sadly, by the Securities and Exchange Commission, supposed to be your watchdog, when it repealed an old Depression-era regulation called the uptick rule that had previously forced short sellers to wait for above-market prices before they could offer stock, sell stock. And you know what? Once they did that, got rid of that rule, the short sellers were able to hammer down every bank in sight. And they went right through the buybacks. You'll also see executives try to call a bottom in their own stock by announcing major buybacks. So give me a break. These attempts at Babe Ruth-style cold shots almost always fail. What do these CEOs know about the stock market? They're running their businesses. They should pay attention to their businesses. Turns out to be a huge waste of your money as a shareholder. As it turns out, the executives trying to call the bottom often turn out not to understand the way stocks work, their own stocks work, as well as you would have expected. And they ended up pouring fortunes into trying to create the appearance of a bottom while their businesses were still in decline. Here's the bottom line. Buybacks by themselves are no reason to own a stock, and in some circumstances are reason enough to sell it. I think you never want to own the stock of a company that's wasting the money it needs to survive on useless, endless buybacks, or even worse, spending money it doesn't have on an activity as fruitless as repurchasing its shares. And you shouldn't rely on even the largest buyback to help prop up a stock if the situation becomes dire. The way I see it, from now on, buybacks, false sign of health, and too often a waste of your shareholders' money.